Hello traders, we are in free smart money trading course episode 2. We are going to talk about spikes in markets. Some of these trading concepts are from smart money courses. Some of these trading concepts are originated from liquidity inducement trading or ICT trading. Some of them are just technical analysis because purely trading smart money concepts is gonna make you getting a lot of stop outs, but we can lessen those stop outs by broadening your knowledge about markets. Spikes are important for us because they are footprints of big money or big entities in the market, because they are very impulsive and powerful movements to the upside or to the downside. So, or something big happens in the markets, or a lot of stacks of big orders are operating in the markets. What's the spike? A spike is a very high momentum movement which prints a lot of consecutive same color candles to the upside, so blue or green, and to the downside, for example, red. And those spikes has three reversal POIs that if we have enough confluence in there, we can look for trading opportunities. These 3 points are going to be the first demand zone that made the first movement of the spike, which is about 78% of this spike. And it's going to be the spike base, which is from 38% to 62% of this up movement. And the last candle of the spike, is going to be a liquidity point if it grab that liquidity and starts to go lower. We have 78%, which is this line. We have 38% order block, which is this line. And we have this line, which is the low of that spike. You can see that it first came up, it reacted to this 38%. It came down, it liquidated the 38% and reacted to 78% of that spike, and then it came down. This low is 19,003 and a half. This low is 19,003. So it's a little bit lower than this point. It liquidated this low and it went to the upside, reacted to this rejection block and came down. So 38%, 78%, and sometimes between 50% and 62% are important for us when we are trading spikes. From here, you should grasp the concept of fractals in the market, higher time frames and lower time frames. A spike is not a spike in lower time frames. It can be a big ass trend in very low time frames and have a lot of candles, a lot of different color candles, a lot of up movement and down movements. So if you need a lot of candles in one direction in lower time frames, that can be a spike in higher time frames. And a spike in higher time frames is gonna be just one big candle. Let's talk about this exact movement. You can see that it's 4 hour. For example, if I go to 15 minutes, you can see that it's a very big trend to the downside with a lot of up movements and down movements. And for example, if I go to weekly time frame, you can see that it's even not a candle, or in daily it's just 2 candles, 3 candles to the downside. I know that you're in love with this course and me right now, so just subscribe and like. And if you have any question or any other things that you want to see, just say in comments. Let's go. Most of the times they come after consolidation. Why? Because the consolidation is a market structure that the traders say that, okay, this price for now, for these fundamental conditions is okay for us, so we stay here. But after that something happens or some transactions happens and the market breaks with a spike. Always a good breakout happens like a spike, because a choppy breakout may not have the good momentum and the good determination of traders in it, so it can just reverse and go to the opposite side. But spikes happens at the end of a trend too. For example, it is gonna go higher and higher and higher, and we see that a very impulsive movement at the end of a trend that can be fundamental or technical, and then it reverses. We call this a buy climax, or when it is gonna go here and then it starts to go higher, it is a sell climax. So all the time it's not a breakout, and sometimes it's just trapping other traders. SPIs are important because they are the ultimate sign of money transferring into the markets or out of the markets. I know a lot of traders, they are just momentum traders. They look for a spike and they try to hop on that movement after a pullback, especially after big news. But it's important to look for confluences. Confluence of a Fibonacci level of a spike with moving averages, with support and resistances, or with order blocks, or even with financial news. If you don't get a confluence, you don't know if the spike is gonna work or not, and which level of a spike is important for us. So it doesn't matter which methodology you are using. If you are a support and resistance trader, if you are an order block and an ICT trader, I don't think any ICT trader are going to make money. If you are a smart money concepts trader, just try to use confluences, not just one methodology. I use smart money concepts, ICT concepts, liquidity concepts, with confluence, with moving averages, with confluence, with a very deep understanding of sessions and the levels between sessions you can see on my live trades and charts. So I have a higher win rate with a robust trading plan and strategy that can keep me consistently profitable. For example, you are looking at it right here. We have a spike to the downside. It's 38%, and we have a very good opportunity here with this resistance. Another level is here. We have another spike here to the downside. We have liquidity pools and moving averages, and it's on its 78%, I think. So when you look for the spikes, you are looking at the right direction of the market. And when you are looking at confluences and sessions, you are looking at the exact price and exact time that you can hop on that movement. For example, here I have my moving averages open. You can see that we have a Fibonacci level of more than 50%. No, it's 38%. Plus our liquidity point here, plus this moving average, which is the exact $19,000 level. It's from here to here. This is the 19,000 level. And another example is this price. Yes, some of them are scalp trades. I'm just talking about concepts. I don't care about trades right now. You shouldn't care as well. 70% and moving averages. You can see that we have a very high momentum spike here to the upside, and higher time frame moving averages. It is for our 200 EMA, and you can see that we have that with our 62% of this spike. We have a lot of good examples on charts. It's just the confluence between 78% and this rejection block. You can see that you could take this trade too, and a lot of other examples. So these concepts that I'm talking about happens a lot, and you can take trades like these trades that I took here on gold. You can have statements like this monthly statement that it's monstrous. You can see that right here, and it's more than 100% a month. You can do these things with a robust and deep knowledge about the markets. Yes, it needs a lot of determination, a lot of work, a lot of studying, a lot of back testing and forward testing, but eventually you are gonna learn what I want you to learn. These concepts are tested. I'm using them on my daily journey. You can see a lot of examples of live trades that I break down for you in 1 minute shorts, especially in Instagram, and you can see that I trade daily, and that's the most important thing that teachers should do. Most of teachers out there, they don't click for a trade in a month. They just sell courses. So it's important to trade daily because I love these markets and I love making money with these markets. My crypto basket is up for 200%, I think, this month. I have a stock market basket as well, and this is my job, and I trade daily. So when you trade with the concepts that you are talking about, it's gonna filter those concepts in the long run, and I'm more than happy to share them with you. Thank you for your watching. Don't forget to subscribe